Hello, everyone, and welcome to our monthly review of the economy. The sudden rate increase by RBI is the highlight of this month. Although the central bank was veering towards reducing accommodation, but 40 basis point increase in repo rate and accompanied by 50 basis point increase in CRR indeed came in as a surprise. Now, this is a very clear signal that rates are going to move up from these levels. We do expect interest rate hikes of 75 to 100 basis point beyond what RBI did on May 4. Today's discussion is on what prompted RBI to do this and what are its implications. There are four reasons behind surprise move by RBI on May 4. Number one, of course, is inflation. Inflation had not only been rising, but was also getting broad-based. Just to give you an example, in 21-22, we saw 5.5% inflation. Now, this was largely due to fuel and due to core inflation. Food inflation was still benign. But as we move into 22-23, the data is showing that the pressure on inflation is coming from all sides, whether it is food or it is fuel or it is core. I think all of them are expected to move up. So it becomes very difficult for RBI or any central bank for that matter to ignore the generalized inflationary pressures in the economy, even if the demand is weak. So this was one of the key reasons that prompted RBI to raise rates. The reason number two was the actions of the Fed. The Fed had been getting quite aggressive with its communication. It had already delivered a 25 basis point hike and was expected to deliver a 50 basis point hike on May 4 itself. Now, what that does is it creates the interest rate differential with the emerging markets. And even though India has today lower current account deficit, it has a better forex shield than it had in 2013. But still, I think it is exposed to capital outflows. In fact, capital has already been moving out from the equity markets. There has been a net capital outflow since October. So I think to mute the impact of Fed actions on capital flows out of India, this move was a good one. The number three reason is inflationary expectations. The central bank was worried about inflationary expectations getting unanchored. That's not a pleasant situation to deal with. The fourth reason is that the central bank owes an explanation to the government if inflation stays above 6% for 3 consecutive quarters. Now let's take January to March, which is already above 6%. For the next quarter, the central bank has already forecast 6.3% inflation, and it is very likely that in the third quarter of this calendar year, we'll again see inflation above 6%. So I think because of all these reasons, a number of factors, adverse factors coming together, it became very critical for the central bank to deliver on rate hikes, and they did it on May 4 in between the two policies. So what does this imply? Well, I would like to make 2 points in this regard. Number one, to be sure, the central bank cannot control inflation in food items or for that matter, even in fuel items. What it can do is restrict its transmission to the rest of the economy. And the RBI is precisely trying to do that and is trying to prevent the inflation from getting further generalized. Now, the point number two is this move means that there is decisive turn in the monetary policy, and we should brace up for further rate hikes going ahead. This might be bad news for borrowers, but it might bring some respite to savers who were getting negative real returns. I think their returns will start moving towards a positive territory. Thank you very much for tuning in. See you next month.